Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1476. Thank you so much for joining me today as the stock market is booming, the housing market is booming, and Rome is burning. It's crazy what's going on in the world, as we know and have discussed numerous times. But what's even crazier is how all of these parts of the economy are just doing well as we have this massive unemployment and chaos in the streets. But what does that mean for cities? Well, it's a double whammy. First, I predicted 2.5 months ago that the pandemic, maybe it's 3 months now, the pandemic would push people into the suburbs. And now the civil unrest is another reason for them to get out of the city. And I'm looking at an article here that Evan posted in our private content group, and basically talks about elevator phobia, something I talked about 2.5 to 3 months ago. The media is finally catching up to me. I'm going to keep mentioning that for a little while longer, then I'll stop saying it. But it's just great to be first. I was the first one that saw it, that I know of. If I'm wrong about that, go to jasonhartman.com/ask and tell me how wrong I am, and I will correct the errors of my ways. But the article says, imagine what happens to rents if your potential tenant pool shrinks by 15 to 20%. They're talking about downtown landlords, both commercial and residential. And by the way, we are noticing rent collection to be extremely strong, really almost like it wasn't even mentioned. Like we should have never even bothered talking about it like we were a couple of months ago. But I'm still seeing articles talking about apartment rent collection weakening a little bit more, but still strong. And now, the June 1st rent has been due for a couple of days. So, there's always a little grace period. And we'll know what happens with June rent in about a week or two, okay, in terms of the big institutional apartments. It's interesting what's happening. I want to say congratulations and thank you to all of you, and there were so many that attended our asset protection, asset defense webinar. By popular demand, many people have asked for us to run that again. We will run it again, and I think we can use, I don't know if we can use the same link. So don't worry, next week we'll get that webinar running again for you, because a lot of people have asked. They attended once, they want to see it again, or they couldn't attend and they want to see it. But I do want to answer a couple questions. Number one, and this is before we get to our investment counselor, Doug is our guest today, talking about a well-known book in economic circles that you're going to want to hear this interview. It's very informative. So we'll have that coming up in a moment. But two things. Number one, our attorney who we hosted on the webinar, he does offer a guarantee. So if you go ahead and sign up for his package, and we gave out the link on the webinar, and you have the consultation with him and you decide, I don't need to do any of this stuff, it's not for me, he will refund you, okay? So you do get the consultation money back guarantee, okay? So as long as you don't move forward and actually form the entities and create all the structure, you can get a refund after your consultation. Okay, so just keep that in mind. And then another question we got is, someone asked, what is the difference between the program outlined on the webinar? And by the way, of course, we will be announcing another webinar next week. So don't worry, just if you didn't see it, then you can come next week. We'll probably run that next Wednesday, okay, next week. And we'll give out a link on maybe Monday's episode for that. But what is the difference between his strategy and the Series LLC strategy that I talked about with a different attorney on the show a little over a year ago? He can form a Series LLC for you. But here's the thing about the Series LLC. The concept is, and again, I'm not a lawyer, I'm not a tax advisor, this is just my lay person's understanding, okay? But the concept is that you can have just one LLC that has many, we'll call it children or series under it, okay? And each one of those series, in theory, would act like a firewall. Now, some lawyers trust this model and some don't. The Series LLC is not recognized by every state, and it is also a newer animal. And when something is new in the legal world and it hasn't been tested a lot, and there's not a lot of case law, meaning there were lawsuits and the court ruled this way or that way, that's when there's case law, there's a history, there's a precedent to create more law about this new vehicle, okay, that in this case, the Series LLC. Then lawyers and clients start to feel more comfortable with it because it's been tested. If it's going to be tested, let it be tested by somebody else, not you, right? And so Bob, as part of his offering on the webinar, can form your LLC in any state, and he can do a Series LLC for you, but that doesn't mean that you want to do one necessarily. So that's why you have a consultation with him. This is a real attorney thing. It's not some hokey mill where there's no attorney, and you can figure that out with him in your individual consultation where he looks at your individual situation. Okay, so I just wanted to mention that. And if you need us, of course, reach out. We're here for you, to guide you, to assist you along your investing journey and your wealth building journey and wealth defense and protection journey. Go to jasonhartman.com or call us if you're in the United States at 1-800-HARTMAN, and we are here for you. Our investment counselors are happy to do portfolio makeovers, talk to you about different markets around the country, depending on your time horizon, your risk tolerance, your investment goals. And if you need help with considering selling properties or refinancing properties, doing 1031 exchanges, or the 1031 exchange alternative that we talked about on a recent podcast. They'll help you with all of that stuff too. And of course, that's how you reach them. Okay. So let's talk to one of those investment counselors right now. And pretty much all of our investment counselors start out as clients. And this one is no exception. You've heard Doug on the show many times over the years. He was a client starting maybe, 11, 12 years ago. He became a client and started buying investment properties and then has spoken at a few of our events, Meet the Masters, Profits in Paradise. And now he wanted to talk about a well-known book in economic circles and a well-known guru in economic circles and what it means to your investing strategy and your portfolio and your overall goals. So that's what we will do today. Let's go ahead and bring Doug on the show. Hey, it's my pleasure to welcome Doug back to the show. He's been on many times. You've met him and seen him speak at our Meet the Masters and Profits in Paradise events over the years. Also, he was the one who hosted the portfolio makeover games in various different iterations over the years. And it's great to have him on. Doug, how you doing?
Yeah, doing great, Jason. I mean, as great as anybody's doing, with the world coming to an end. But
yes. Well, we're going to get into the world coming to an end. And we're not so somber about it either, as some are. But speaking of the world coming to the end, maybe we'll start right there. You are right now really following, more so than before, Mark Spitznagel. And
that's correct.
He's the hedge fund manager. He's got a few books out, another one coming out next year. But I believe you're currently reading the Dao of Capital, and that's Tao, D-A-O, but pronounced Tao, I believe. And then it's the Austrian Investing in a Distorted World, with foreword by Ron Paul, who's of course been on the show and spoke at our Meet the Masters event 2 years ago. So he's really a doom and gloom investor, right?
That's correct. And to give the listeners a little bit of context, so Mark Spitznagel was a student of Nassim Taleb at New York University.
And I'm a big fan of Nassim.
Yes.
Yeah.
And so Taleb, he wrote Fooled by Randomness, Black Swan, Anti-Fragile, probably one of my favorite authors, probably
Skin
my
in the
top.
Game. You must read Skin in the Game. That's maybe the most important one of all. Yeah, go.
Yeah. Yeah. Skin in the Game and Anti-Fragile, I think, are probably two of are probably his magnum opus.
Right.
And the thing that's unique about Spitznagel is that, of course, he has an obviously very bearish perspective, but Untitled Chapter booked I think 3,612% gain in March of 2020. And if users are saying, not users, sorry, listeners are probably saying, wait a second, 3,000, so 36x? Yes, 36x. And because his whole strategy is about buying, it's largely about options. It's about buying options that are way, 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 way out of the money, that they can buy for almost nothing, that normally don't pay off. They normally burn capital in time decay. But when a crisis event happens, those types of things just shoot up in value. And in this case, there was a crisis event. Volatilities went up. The Dow went down. The S&P went down. The values shot up, and they booked a whole bunch of gains. And so, what we can learn from someone like Spitznagel is his strategies, because of course the exact strategy is going to be hard for the regular person to implement, but the style of strategy, as he says, the Dao of Capital, what he talks about really is the idea of, instead of focusing just on how much money you make, focus on how you're positioned so that you will be able to consistently move your position to take advantage of opportunities that come up. Because a lot of times, if you just try to make money now, what you'll end up doing is you'll end up locking yourself into a course of action that you can't very easily adjust. And in the world right now, it's really positioning yourself so that you can be flexible, because nobody knows what's going to happen. COVID could, it could take another dip, or it could be solved next week. Nobody knows.
Right.
And I think that's the really important thing that a lot of people can take away from it. And I think that's one of the things that you're really helping people to do with your pandemic investing.
Yeah, thanks. I'm beginning to wonder, and I think a lot of people are, but this is sort of easy to say, and I can't say it's hindsight yet, but it feels like we're getting to the era where this is it's moving into the background a little bit, right? And not everybody, but some are now asking, a lot more are asking, was this just a massive overreaction? Of course, the conspiracy theories are flying, and some of those are definitely worth entertaining. I haven't had much time to investigate any of them, frankly, but, we've got to remember something, folks, that if you're in the U.S. or, other countries have similar things, but, in the U.S. we have a constitution, okay? And the government has just, frankly, trampled all over that. And the First Amendment, the very first thing is not only the right to free speech, which, I think we all pretty much have, unless you're on one of the big tech platforms, Facebook, Twitter, the rest, which decide that they're going to censor speech, which is absurd, Google, etc., but the right to peaceably assemble. Okay. So what if you wanted to have a political rally right now? You couldn't do it, right? It's just something we need to remember, that, there's, who knows? Nobody knows. We may never know really what the significance of this whole thing was, and if we've overreacted or not. But Spitznagel, now, you quoted a 3,600% return, but I'm looking at a thing that says like 4,400%. I think that's the annualized number, right?
That's for the whole year.
Yours
that's
was
for the
for
year
a
to
month.
date. I was for 1 month.
Wow.
In 1 month in March, it was a 3,600% return.
Mm-hmm. Yeah. So
it doesn't do that every year.
Yeah. So what did he invest in? Ventilator stock or face mask? What?
And so I'm actually working with a friend of mine because I think he's good friends with one of the deans of business down at Portland State. And so he spends a lot of time in the Bloomberg lab. And so one of the things that we're working on doing is reverse engineering the trades of Universa to figure out what their positions were. But from what I understand, a lot of what he invested in were things like, say, when the S&P was at, like, say, 3,300, what he would do is he'd buy options at, say, 2,800 or 2,500 or something like that, way, way, way out of the money, which it turns out hit. If you have an option that goes from super far out of the money to all of a sudden now the market price is at the option price, your price just goes up a hockey stick curve.
Right.
And that's almost certainly what they did, because those are going to be your most liquid options. Those are the options you can get for the longest amount of time. And then of course you can also do things like you can cherry pick weak companies. Like of course when Tesla was trading at $900, that's an easy long-term put. Just go way, way out of the money because they're going down. A number of other over-leveraged companies that are extremely fragile.
Right.
When you have a research staff that's looking for companies like that, you can use financial derivatives very effectively that way. You can also use financial derivatives very ineffectively, but that's how the game works.
Well, what you're basically doing is just betting on the long shot. And so the long shot bet is a cheap bet and the odds are good, but again, the odds aren't good. The odds are terrible, but when it pays big. That's what I meant to say.
Exactly.
It's like, going to the horse races and betting on the horse that never wins. It's the odds are that you're going to lose your money, but you don't lose much and the payoff is big. So,
exactly.
What does this tell us for real estate investors, if anything? Maybe nothing.
So I think what it tells us for real estate investors is that in the case of Spitznagel, he was positioned to take advantage when there was a big disruption. Now most real estate investors aren't going to be allocating say like, $50 million to Universa Capita, but, we just don't have the capital base to play in that kind of game. But what we can do is we can make sure that we are adjusting our personal portfolios so that we have the ability to be flexible. Because I know that one of the ideas that you present in the pandemic investing is to segment your capital between cash flow, your regular cash flow holdings, to have some speculation for upside, to have some hedging to protect against downside, and to keep some of your holdings just in cash, just in liquid reserves. And I think that construct is really important because what it does is it lets you shift your position as the market evolves. So, for example, one of my clients that I was talking to recently, he has a property in the San Francisco Bay Area it's a multiplex. It's doing very well. And he was concerned about not being able to replace all the cash flow if he took the equity out of that and then reinvested it someplace else. Ideally, someplace down someplace like Texas or Florida. Well, but some of the conversations we've been having are that, the Bay Area right now is basically at or very near a price peak. And of course, it's hard to time the market, but it's hard to imagine that the Bay Area is going to continue appreciating the way that it has in the future. Well, so one way that
when you say at or very near a price peak, you are insanely optimistic if you ask me, but go ahead. Okay.
Yeah. Well, and so that's the thing. Yeah, a lot of real estate in the Bay Area is actually probably down off of its peak.
Oh yeah,
and it's probably not going to be back there for a very long time, because I think the prior peak was 2007, and it took until I think about 3 or 4 years ago, or something like that. It took almost a full decade to get back to those peak levels. And it's very likely that it's going to be at least 5 to 8 years before the peak levels we saw just a couple months ago, before those can be replicated. So the question is, if you can pull some equity out of something that you have in a volatile market, like say the Bay Area or Southern California or New York, then what you can do is you can say, okay, now you have some flexibility because you have a cash base. And for example, he's very fond of our LMS in Jacksonville area. And so this particular client, he's developed a very good relationship with one of our local market specialists down in the Florida area, down on the Florida coast. And one of the things that he really likes that we talk about a lot is how there's a lot of population that's migrating toward Florida. A lot of population from the East Coast is moving toward Florida just because of, the favorable weather, the favorable tax status, et cetera. Well, when you have these population migrations, what it does is it puts upward pressure on both price and rents. In all likelihood, in the near future, there's going to be probably more upward pressure on rents. But at the area where our clients are investing, you're also going to have upward pressure on prices because you'll have a lot of people coming down from more expensive real estate. And if we have quality product that's priced below median for an area, right, it's very hard. It's very hard to imagine a situation where you wouldn't have demand for those types of properties.
Doug, this is such a significant trend, and we've been talking about it on the show for quite a while now. This mass migration out of high density, expensive areas to low density suburban areas. And think of it like this, everybody listening. It's like the person in Las Vegas who just won a bunch of money, and they go out and they celebrate and they spend money like a drunken sailor. And that's kind of how it is. Or it's sort of like when we've, it depends on the era. There have been times when, for example, Australian investors, or from any part of the world, but I'll use Australia as an example because that was a particular one, where our dollar made our real estate look cheap to them. And they came here and bought up stuff like crazy. And even if the investment wasn't that good, they were simply arbitraging the currency trade. Okay. Just the currency trade alone made the deal good. Okay. And, that can work both ways, obviously. But when someone leaves New York City with the astronomically overpriced real estate there, and they sell their property even at a loss, or maybe they don't even own, but they take their housing budget and they bring it to a place like Florida, it's like everything looks super cheap to them. And so that they spend more freely. And when they spend more freely into the market, that really puts upward pressure on prices. So this is the trend that is already happening to a small extent, but as these quarantines are lifted, is going to really, really gain steam. And I'm not just talking about New York and Florida. I'm talking about any high density living anywhere moving into lower density living where people can socially distance and feel safer. And frankly, that trend was already underway. This is just putting it on steroids and adding rocket fuel to it, because the trend was already happening, and we've reported on that for years and years. But now it's got legs galore. And if you want to just look at some numbers for a moment, Doug, you're a numbers guy for sure.
Absolutely.
Let me just tell you about rental units only. This does not, I want to clarify, this does not include condos. This is only rental units, okay? Mid-rise and high-rise buildings in terms of rental units. And during the pandemic investing webinar presentation that we will be announcing soon, we will go into this in greater detail. But there are about 2.3 million of those units now that are mid and high rise. In other words, places where people are trapped in an elevator, a danger zone, and places where most of the time people are using mass transit, another danger zone. That's 2.3 million units. Now, each unit has maybe 2 people, for example. If only 15% of those people want to move, and I think that's a small number, by the way. I think it's going to be bigger than that. Okay, now, just because they want to move doesn't mean they all will move, whatever. I think there's going to be a higher number than of that in terms of potential movers. That's 340,000 units needed. Spread that among 50 markets. That's another almost 7,000 homes needed in each market in an era when we already had, before any of this, a massive housing shortage. Okay.
And Jason, I'd actually like to append on what you're saying.
Sure.
You're saying there's 700,000 homes needed, and they're not 700,000 homes.
340,000.
Okay, yeah, 340,000.
At the 15% number. Mover number.
Exactly. Yeah, they're not 340,000 homes that cost $750,000 each.
Exactly. Yeah.
They're 300,000 homes that probably need to be more in the
250,
right around in the sub 250, which there's not a lot of inventory.
Right. Well, not only that, but think about if someone owns their high-rise condo in New York, they sell it for $3 million, or say they got to do a fire sale and they sell it for $2.5 million. So $2.5 million, they move to suburbia, and to get just a gorgeous home in suburbia, they can spend $600,000. Now their housing cost has dropped dramatically. Everybody's worried about the economy being so bad, but look at all the extra spending money that family now has. Look at their ability to buy additional rental properties and the upward price pressure that creates. Okay, so I mean, our investors following our plan can just win, win, win. Now, I'm not saying the economy is okay, because I don't think it's okay at all. I think the economy's got major problems. But the issue is it's this war between the economy overall and the mass migration trend and how it affects real estate, both rental and for sale real estate in markets we're targeting, that you can find at jasonhartman.com/properties. There's your Spitznagel hedge fund strategy in real estate, right?
Well, and I think that the two ideas play in, because in the Tao of Capital, one of the things that Spitznagel does is he compares and contrasts Sun Tzu versus Karl von Clausewitz, because in a lot of cases, a lot of people think,
the art of war, that's Sun Tzu, but what is Karl's philosophy?
So Clausewitz was a Prussian military thinker in the very early 19th century, and his book is called On War, and it's about tactics and strategy of warfare, but it's really about how warfare is an extension of commerce and more aptly an extension of politics, meaning that the strategies that are used in warfare can be applied to can be cross applied to many different many different spheres of human existence, right? Because a lot of people think, okay, war is just killing people. Well, not quite. There's a lot of strategy involved, and the strategy is how do you position yourself so that your consumption of resources for maintaining your standing army, your ability to defend, and your ability to attack plus counterattack are all optimized. Because what a lot of people do, especially in the era, is they'd immediately go for a quick win, or they'd go for a visible win. In our case, that would be somebody who's going for as much money as they can make right now. But what that would do is that would lock them into certain positions that would limit their flexibility. And so what would happen is you'd have, say, for example, one general who would retreat their army, someone would pursue after them, they'd get overextended, and then they could turn their flank and actually defeat a much larger force with a small concentrated force. I think the extension to investors is that flexibility is really important. So like, for example, you're talking about, say, somebody who moves out of the city and moves into the suburbs. And then now they have some extra capital that they can hold in reserve and that they can use to start buying rental properties. And because like some clients that I've had, they've said, okay, well, I'm going to liquidate some holdings. I'm going to have some capital. I'm wondering whether I should deploy it all at once, or whether I should sit on it, or what I should do. And my advice is usually, just make a plan and follow a methodical plan, because it might be an L-shaped recovery. It might be a U-shaped recovery. It might be a V-shaped recovery. We don't know. And so, what you do when you don't know is just make a plan and be methodical and consistent, because then that gives you flexibility. So instead of buying, say, 10 houses right now, maybe you pick up 2, and then 2 more, and then 2 more, and then 2 more. But by just being methodical, what that really does is it gives you that flexibility and that positive movement that will really help you adapt to however the market unfolds, because we don't know.
Right. And is that another way of saying dollar cost averaging?
Exactly. Yeah. Yes. That is although, that's a way, it's basically averaging in, or dollar cost averaging. Mm-hmm. The way that you would do that, the way that your financial planner would recommend doing that is to just basically put the same amount of money into a mutual fund every single month. Yeah.
Now a lot of the fair warning though, a lot of times dollar cost averaging is just being used, particularly by the Wall Street cartel, to essentially just get you to keep investing in crappy investments. So, to be fair, I mean, the concept certainly makes sense in some ways, but it's also used as a cover, which is what I hate about it, so. Well, yeah.
And see, that's the thing. Yeah. Averaging can't turn a bad investment into a good one. What it can do is it can smooth out your timing so that you don't have to try to figure out the exact top or bottom.
Mm-hmm. Right. Which nobody can figure out. Okay. And
that is correct.
And that's definitely the thing. So good stuff. Let's talk about market timing for a moment, then we'll wrap it up. So the market timers I find them incredibly frustrating and silly. And here's why. Number one, they say things like this, well, I'm going to keep my cash so I can pounce on all the deals during the next recession, and I'm going to really profit by doing that. Well, that's what they say. But then what they forget to say is that they said this in 2013, and they waited 7 years for the pandemic to happen or the recession. We got it this way, which it was coming anyway, because it's always coming. And they lost out on the opportunity to get any return during that time because they were in cash. So they didn't buy those real estate deals because they thought they were too expensive. They didn't buy the stocks because they thought they were too expensive. So they missed everything. And taxes and inflation ate them alive. So they never calculate the return they lose by waiting. That's a dog that doesn't bark because it's an opportunity cost. And then the other thing that happens is when it comes to real estate, they don't consider their mostly lack of ability to obtain good financing. It's amazing, Doug, how myopic people are. I hear all these economists, like these supposedly brilliant people. One that I'm particularly frustrated with is Robert Shiller, Nobel laureate Robert Shiller, who completely misses the whole concept of real estate. He acts as though everybody buys real estate with cash, and their only return on the real estate is the nominal appreciation rather than the multidimensional benefits of that investment. That's one thing. Another thing is his index is 2/3 weighted on cyclical markets. Super frustrating. But the thing they don't consider, these market timers, is the price of the money. They think they're just buying the house. What they're really buying is the mortgage. And they say, well, housing prices have gone way up. In fact, they're at the price they were before the last peak. Okay, and then what happened? We had a recession. But what you didn't notice is what the mortgage payment was at that time versus what the mortgage payment is today. That's the true cost of the house. It's not the price. It's the payment. People don't buy houses on a price. They buy it on a payment. If they bought it on a price, houses would hardly appreciate at all. They're buying it because the payment is affordable, not because the price. They don't care about the price. Nobody says, oh, gosh, this house is $400,000, so it's too much for us. No, they say, okay, the payment on this house now is only $2,000. And gosh, we were looking 12 years ago, and the payment on a house like this, they don't care about the price, just a house like this, square footage, age, neighborhood, etc., okay, was $2,800. It's cheaper now. Houses are cheaper, okay, because you evaluate it on a payment, not a price. My God, that seems so simple, but apparently Nobel laureate economists can't seem to figure that out. Blows my mind.
And also, also, I think it goes even a little further than that because in a lot of cases, it's like you say, you want to evaluate on a nominal payment, but if you evaluate on a real payment and then deflate for constant value dollars.
Oh, yeah. Very good point. Sure.
That the real cost of owning houses is actually surprisingly affordable.
It's incredibly cheap, really. Yes. So inflation adjusted real dollar mortgage payments. That is the only real metric you should give a lot of weight to. Of course, there are some other things, but that's the one you really look at. And, it's stated fairly clearly in the Housing Affordability Index. So there you go. Doug, any final remarks to wrap this one up?
Well, I think the main thing is just that, there's a lot of fear out there, and I don't think people need to be afraid. I mean, cautious, yes, aware, yes, but afraid, no. There's going to be opportunities. And, for people who are paying attention and taking action, there's no reason to think that, that that the future is going to be blighted. The future is going to be difficult for a while, but then it's going to be the future, and there'll be opportunities. So just take them.
There's always opportunities, always opportunities. Good stuff. Doug, thank you so much for joining us. Anybody can have you help them with their investment purchases. Go to jasonhartman.com or reach out at 1-800-HARTMAN. And until tomorrow, happy investing.
Happy investing.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.